The last two videos we spent a lot of time talking about the difference between fixed costs and variable costs, and we said that managers that want to take a lot of risk should have more fixed costs, and those that are more risk averse should maybe opt for a more variable cost structure. Well, this idea of cost structure is so important in managerial accountancy that they actually reorganize the income statement to so that they can see the cost structure, and so they reorganize the income statement into something called the contribution margin format. We're gonna talk about that in this video. If you remember from financial accounting, I'll put financial over here. What we use for external reporting, we basically divided the income statement into product cost and into period cost. So we had a sales revenue. I'll just put revenue over here plus our cost of goods sold, which is CGS, and that gives us our gross margin. And then we take out our selling and admin expenses, and that gives us a net income. So the income statement was really divided between product cost and period cost. Our product cost was right here as cost of goods sold, the product cost, and then our period cost was down here as selling and admin expenses. Well, in managerial accounting, we're really not as interested in differentiating between product and period cost. We're really more interested in differentiating between variable cost and fixed cost. And so we're going to organize our income statement this way. And remember, in managerial accounting, there are no results. You can organize it however you want to organize it. In financial accounting, we had to follow some basic structure though. In managerial accounting, we can organize the income statement in any way we like. And a way that managers often organize it is this contribution margin format. So with contribution margin format, we're going to take all of this revenue and then we're going to subtract it out, or we're going to subtract it out of the variable cost. And that's going to give us something called the contribution margin. And contribution margin is basically the amount that is available to cover fixed costs. So after you paid all your variable costs, how much is available to cover fixed costs, and then ultimately how much is available for profit? So we take out all the variable costs and then we get our contribution margin. Then we take out all of our fixed costs and that will give us our net income. So using the contribution margin format, product and period costs are not separated. This variable cost up here includes product and period costs, and the fixed cost down here could also include product or period costs. And no matter what approach you get, net income is going to be the same. The net income bottom line number is going to be the same. Just how are we dividing the cost over here? Are we dividing based on product and period cost, or are we dividing based on variable and fixed? So let's look at a quick example. All right, let's look at a contribution margin income statement. We have a regular income statement right here, and this is the kind of income statement that is used for financial reporting. You can see that I have my product cost right here. Then I have my period cost down here. So I want to take this income statement and convert it into a contribution margin format so we can use it for analysis. And so your sales is going to be the same as revenue. In this case, it is $300,000. And then we're going to take out our variable costs. So we need to identify which of these costs are variable. Let's go through this to find that out. Cost of goods sold, this is going to be a variable cost because it changes with volume, it changes with the number of units sold. Sales commissions, they are 10% of sales, and sales are based on volume because sales are based on units also. So sales commissions are going to increase as sales or volume increases. So this is again also a variable cost. Administrative salaries expenses, expense $25,000, that's going to be a fixed cost. It doesn't matter what our sales are, these employees are going to be paid $25,000, right? So it is fixed. Advertising expenses, which is $31,000, this is also fixed cost. It doesn't matter how many sales we have, our advertising is fixed at $31,000. And depreciation expense, that is also fixed. It doesn't change with volume. Okay, the last one's shipping and handling expense. It's 2,000 units at $1 a unit. So for every unit, we increase shipping and handling expense by $1. So this is a variable cost. So now we classify these costs as we've seen to make our income statement. So we're going to have less variable costs. So the first one is the cost of goods sold, which is CGS, and that is $180,000. The second variable cost is a sales commission, and those are $30,000. And then our final variable cost is the shipping and handling expense, and that is $4,000. So that's all of our variable cost there. So our sales less our variable cost is going to give us contribution margin. In this scenario, that would be $86,000. And then we're just going to take out our fixed cost. That means less the fixed cost. And a fixed cost, we said we had three of them. We had this administrative salary expense, this advertising expense, and the depreciation. So we're going to have administrative salaries, admin salary expense, which is $25,000. And then we have our advertising expense, which is $31,000. And then we have our depreciation expense, which is $24,000. And so contribution margin minus our fixed cost is going to give us net income, which is $6,000. This is a contribution margin format income statement. As you notice, net income under the traditional format is the same as it is under the contribution margin format. So it's not actually changing the numbers, it's just changing the way we organize the information. And the main thing we get out of this is we get to know a contribution margin, which in this case is $86,000. In the next two videos, we will see how we can use the contribution margin to assess the profitability of a company or the potential for profitability.